Hey, welcome back, subscribers, to my world of stocks, and welcome back to our Buy Heavy series, where I bring you a new stock that I'm currently buying heavily myself, on a major dip that I feel looks super attractive for the long term. And this time I have a very special episode for you because coming off of an earnings dip just this past week, I am now getting what is literally my overall favorite REIT stock in the entire market right now at the current price and valuation. And that is, of course, Extra Space Storage, ticker symbol EXR, who was already trading at a discount, but now it's fallen even more on earnings. And so I've been loading up on shares while I still can at these prices. Now, to keep the video as simple as possible, I'm just going to separate this into three quick kind of sections, giving you a short intro on the company and why I'm actually invested in them to begin with. Then in the second part, I'll talk about why the stock is falling, including the most recent earnings from this past week that had it fall even further. And then I'll finish up with part three in this video. I'll talk about why I am still buying regardless of the drop, why I think it can recover long term. So all of that in this one video. Smash the like button if you enjoy these types of videos where I bring you different stocks that I think are trading on big discounts. But let's go ahead and jump straight into it, my friends. Now, just really quick, part one here. If you've never heard of EXR, by square footage, this is the absolute largest self-storage REIT in the country that you can actually invest in, with over 4,000 properties, over 300 million square feet of rentable spaces. They consistently hold over 90% occupancy rates, which is very strong. They're a member of the S&P 500. They've won countless awards for just about any category you can think of, like quality, performance, customer service, most trusted, best company, best management, best place to work at. I mean, the list just goes on. And like I said, they have the most market share here in America, but because it is still at only around 15%, they actually have giant opportunities for more mergers, acquisitions, and growth opportunities long term, which they capitalize on year after year, spending billions of dollars on new investments to fuel that growth, which in turn has led to really higher growth rates than the sector in almost every single year since going public. And even during market downturns, they typically suffer much less than the competition because of their overall size, quality, and brand strength. Not to mention that just the fact that they're a self-storage REIT alone is really the reason why I even looked into them in the first place, because it's a growing market that has proven to be resilient over the long term without any real threats that I feel can actually disrupt it. It's not like brick and mortar retail that can get crushed by e-commerce or movie theaters that get destroyed by video streaming. Storage units are basically always needed, even regardless of what the macroeconomy is doing, because the primary drivers for them are things like life-changing events, moving, divorce, downsizing. These are all events that will still occur regardless of the economic state. In fact, some of those might even increase in frequency during an economic downturn, unfortunately. But because self-storage facilities also require such low maintenance and minimal on-site staff compared to other forms of real estate, they also tend to have much higher margins and more reliable cash flows that not only help them get through those difficult times, but it also allows them to pay consistent and even growing dividends, which in the case of EXR, they've actually more than doubled their dividend payouts in the past decade. But we'll actually come back to the dividend in just a moment here, after I cover a couple other things first. But really, because of all of this, storage REITs have actually generated the second highest returns of any REIT class in the past 2 decades, only behind data centers, which, like, let's be honest, we all know that it's almost impossible to beat out data centers right now because of the rise of artificial intelligence and just how much explosive, mind-blowing growth that area is seeing. But you look at any other class like housing, malls, healthcare, you name it, self-storage really beats all of them. And so all of that is to say that I knew I wanted to invest in a self-storage REIT. And when I looked for the best option among them, it was just very clear to me that EXR was exactly that. In fact, not only is EXR the best performing among self-storage REITs of the past 2 decades, but they're actually the third best among all public REITs across really the entire market. How crazy is that? And again, it's a reflection of that superior size, the growth, the profitability, higher funds from operations per share growth among peers, strong balance sheet that keeps getting better every year, and even a better dividend that, again, I'll touch on in just a second. Just hold on to that for a moment here. But this will, of course, bring us to part two. If everything is so great about EXR, then why has the stock been falling? Well, let's pull up the stock chart here. Not only did it fall by almost 10% just this past week after reporting Q2 earnings, but this now leaves them down a whopping 40% from their highs. So what exactly is going on here? Well, I'll touch on the earnings in just a second because really the bigger drop, of course, started much earlier. So taking a look at that big fall there, 40% crash over the time, we can see that it all really started during this pandemic years, or I would say coming off of that. See, right before this fall here, the stock was actually soaring, and rightfully so, right? For pretty much all the bullish reasons that I just outlined earlier. But ever since that we started to come off of the pandemic, the economy was actually hit very hard with sky-high inflation, soaring interest rates, and just an overall terrible environment for REITs in particular. Because for those of you that just, you might not be aware, REITs rely very heavily on debt in order to finance new acquisitions and to buy and manage new properties, which is where they get a lot of their growth from. And that's certainly something that EXR themselves is heavily known for. Well, when you have high interest rates, it makes borrowing money more expensive while also raising the yield for low risk bonds and make REIT dividends look a lot less attractive or competitive to them too. Well, the result is that REIT stocks end up taking a tumble. They really start crashing when you're raising interest rates by so much. And that's exactly what happened during this period too. And of course, EXR was not immune to that. Now, ever since then, though, the stock did eventually stabilize at these lower levels because there's only so much that the market can really drag down such a strong company, right? Like eventually you're going to have the big institutional investors, the rich elites, the hedge funds start to buy up the stock on the dip, whereas I would say, not to kind of talk bad about them, but short-term traders, a lot of times they panic, they sell at these lower prices, and they tend to be too afraid to buy in on the dips because they lack that long-term vision, knowing that the company will eventually rebound and the stock will take off again over the longer term. But even this past year, EXR continues to struggle still, with this latest earnings report just being another example of that. So why did that happen? Well, you take a look at it here, considering the extremely difficult macro environment, I actually think that their numbers were pretty good, with even their already super high occupancy rates getting even better, climbing up to almost 95%, while their total sales grew too by almost 4% year over year. However, the issue was that property taxes skyrocketed by 19%, which rose their operating expenses, trickling down to their funds from operations, which missed analyst expectations and actually declined very slightly on a per share basis year over year. And that right there, though, is the reason why the stock fell even a little more on earnings, because FFO, funds from operations, is a key metric for profitability for REITs. And not only did that miss, but again, it didn't even grow and it actually declined a little year over year. And yet, I would say that that's probably the least of my worries as an investor. Now, if you ask why, reason is because it had almost entirely to do with the huge acquisition that they made in life storage from a couple of years ago, to which a few states are reassessing those properties now at their higher market value established post-acquisition that they're now charging these higher taxes on, these fees on. In other words, it's not really something fundamentally wrong with EXR themselves, but rather just a speed bump that they have to get past. And so my real concern is almost entirely just on the macro environment, more specifically the high interest rates. But here's why I'm a buyer of the stock regardless, because first of all, interest rates will eventually come down. We all know they will. It's just a matter of time. It's just a matter of when that exactly happens. But once it does start to come down, I have a very strong feeling that this is a stock, among others, that will start to recover big time long term, given how much it's already fallen, but also with how high it's left the dividend yield, where we now have it at approaching close to 5%. Now, not only is that just a very clear resistance level for the dividend, but typically we see it drastically lower of a yield, sometimes even less than half of this level. And so I just see this as a great buying opportunity. I see that as a clear support level for the stock. I think the price is too low. I think the dividend is way too high, and the business is too strong for it to not recover greatly long term. And that's why I've been a buyer myself. But hey, all of that is just my own opinion and what I'm doing myself. You guys, of course, got to do your own research and make your own decisions, but I'd love to hear your thoughts down below. Is this a stock that you like here, or are you buying any other REIT stocks in the market right now? Or do you think the whole landscape is just too risky given the high interest rate environment and everything else going on? I'd love to hear from you. Let me know down in the comment section. But hey, thanks again for stopping by, my friends. I hope you're all doing well, and I will catch you in the next one. All right, take care, everybody. Bye-bye.